Imagine a world where your money has the incredible ability to grow and multiply exponentially over time, creating a path to unimaginable wealth. I invite you to explore and delve into the world of compound interest, where small investments can lead to extraordinary financial achievements. In the world of personal finance, one concept stands out as a tried and true path to long-term wealth creation, and that is the concept of compound interest. The idea of compound interest involves reinvesting your earnings and allowing them to generate additional returns over time. By harnessing the power of compound interest, individuals have the potential to accumulate significant wealth and achieve financial freedom. In this video, we will explore the principles of compound interest and its benefits, as well as discuss some of the best assets to invest in for growth through compound interest. But before we begin, let's understand what compound interest is. Compound interest is often described as the eighth wonder of the world due to its remarkable ability to make investments grow exponentially over the long term. Compound interest is the process of reinvesting profits, dividends, or interest earned from an initial investment, allowing them to generate additional returns over time. The magic of compound interest lies in its ability to generate gains on both the principal amount and the accumulated returns. As time goes on, this compounding effect accelerates, resulting in a significant accumulation of wealth. This compounding effect can be likened to the snowball effect in wealth accumulation. To fully grasp the potential of compound interest, let's consider a practical scenario. Let's imagine you invest $10,000 in an asset that generates an average annual return of 8% over a 30-year period. In the first year, your investment grows by 8%, adding $800 to your initial $10,000. The new total becomes $10,800. In the second year, the 8% return is applied to the increased value of $10,800, resulting in an additional $864. The total value now stands at $11,664. The compounding effect continues, and as the years progress, the growth becomes more significant due to compounding. At the end of 30 years, the initial investment of $10,000 would have grown to approximately $116,026. Interest is not only earned on the principal amount, but also on the accumulated interest from previous years. This compounding effect dramatically amplifies the growth potential of investments over time. In a long-term investment horizon, compound interest can generate substantial wealth. Now that we understand what compound interest is, let's discover the 7 best assets to apply it to, which have contributed to the wealth of the rich and prosperous individuals we see today. Stocks. Investing in stocks and company assets is a popular long-term strategy for wealth generation through compound interest. Historically, the stock market has outperformed most other asset classes over extended periods. Companies with consistent growth, strong finances, and a competitive advantage tend to deliver superior long-term returns. By investing in a diversified portfolio of fundamentally sound companies, you can harness the power of compound interest. Over the years, stocks have provided average annual returns of about 7 to 10%. Let's assume you invest $10,000 in a diversified portfolio of stocks. With an average annual return of 8% after 10 years, your investment could potentially grow to approximately $21,589. High-yield savings accounts. High-yield savings accounts are a type of bank account that offers a competitively higher interest rate compared to traditional savings accounts. This is the easiest compound interest asset to start investing in, as it doesn't require a large initial investment. While the returns may not be as high as other investment options, they provide a safe and easily accessible way to accumulate wealth. Let's imagine you deposit $10,000 into a high-yield savings account with an annual interest rate of 2%. Over a 10-year period, assuming interest is compounded annually, your investment could grow to around $12,189. High-yield savings accounts are ideal for short to medium-term goals or as an emergency fund. They offer a secure and accessible option for individuals looking to preserve their capital while benefiting from the compounding effect of interest. Additionally, some high-yield savings accounts offer the convenience of online banking, allowing people to easily track their progress and manage their funds. Dividend-paying stocks. Dividend-paying stocks are shares of companies that distribute a portion of their profits to shareholders in the form of dividends. These stocks offer the potential for capital appreciation, regular income, and passive income, making them attractive compound interest assets. Here's how dividend-paying stocks can contribute to wealth creation. Regular income. Dividends are typically paid quarterly or annually, providing investors with a consistent source of income. This income can be reinvested to purchase additional shares, accelerating the compound interest effect. Capital appreciation. Dividend-paying stocks can also experience capital appreciation. As the company grows and becomes more profitable, the stock price tends to increase, resulting in capital gains. By reinvesting dividends and allowing stocks to appreciate over time, investors can benefit from the compound interest effect on both income and capital gains. A prudent strategy is to select well-established companies with a consistent history of dividend payments and a track record of increasing dividends over time. Dividend aristocrats, which are companies that have increased dividends for at least 25 consecutive years, are often considered reliable choices. Our recent videos have received few comments, so if you're enjoying this content, don't forget to leave a like or a comment to let us know if you enjoy this type of content. Let's continue with the rest of the video. Real estate. Real estate investments have proven to be an effective asset for compound interest. Real estate investments, particularly rental properties, can generate a consistent cash flow, and property values tend to appreciate over time, offering an attractive opportunity to accumulate wealth through compound interest. Rental income generated by properties can be reinvested to acquire more properties, further diversifying your real estate portfolio and increasing potential returns. Real estate investment trusts, REITs, provide an opportunity for passive and compound interest real estate investment. Let's imagine you buy a rental property for $200,000 with a 20% down payment, which is $40,000, and obtain financing for the remaining $160,000. If the property generates a net annual rental yield of 6%, which is $12,000, and the property value appreciates on average 3% annually, the total return on investment after 20 years could surpass $500,000. With this, you can reinvest the rental income and continue holding the property, taking advantage of the compound interest effect to accumulate capital over time. Bonds. Bonds are financial instruments issued by governments and companies to raise funds. While bonds tend to offer lower returns compared to stocks, they are considered safer investments. Bonds provide a regular stream of income through interest payments, which can be reinvested to compound wealth. Additionally, bonds offer stability to a portfolio and act as a hedge against market volatility. Let's consider an example where you invest $100,000 in a bond with an annual interest rate of 5%. The bond matures in 10 years and interest is paid annually. If you reinvest the interest payments each year at the same 5% interest rate, here's how your investment could compound. In the first year, you receive $5,000 in interest payments and reinvest that amount, resulting in a total of $105,000. In the second year, interest is calculated on this $105,000, resulting in $5,250 in interest payments. You reinvest this amount, raising the total to $110,250. The compound interest effect continues over the remaining years of the bond's maturity. At the end of the 10-year period, your initial investment of $100,000 could grow to a significantly higher value due to interest reinvestment. Precious metals. Investing in precious metals like gold and silver can be a strategic addition to a diversified portfolio. Precious metals have a history of maintaining value and serve as a safe haven during periods of economic uncertainty. While they don't generate regular income like dividend-paying stocks or bonds, their value tends to appreciate over the long term. It's generally recommended to allocate a small percentage of your investment portfolio to precious metals as protection against inflation and market volatility. If an investor has a $500,000 investment portfolio and decides to allocate 10%, which is $50,000, to precious metals, they might consider purchasing physical gold or silver bars, coins, or exchange-traded funds, ETFs, that track the price of these metals. Over a 20-year period, assuming an average annual return of 5%, the investment could potentially grow to around $132,676. Over time, as the value of precious metals appreciates, the investment can compound and contribute to the overall portfolio growth. It's important to note that while precious metals offer stability, they can also experience price fluctuations. Additionally, investors should consider the costs associated with storing and insuring physical metals. Index funds and exchange-traded funds, ETFs. These are investment vehicles that track a specific market index such as the S&P 500. They offer diversification across a wide range of assets, including stocks, bonds, and commodities, allowing investors to benefit from overall market growth. These funds typically follow a specific market index, providing exposure to a set of securities. Through regular contributions and dividend reinvestment, index funds and ETFs can compound long-term returns and achieve long-term wealth accumulation. Over the long term, index funds and ETFs have provided average annual returns of about 6 to 8%. Let's consider a $20,000 investment in an index fund, assuming an average annual return of 7%. After 20 years, your investment could potentially grow to around $67,275. By consistently reinvesting dividends and maintaining a long-term investment horizon, you can harness the compound interest effect to build substantial wealth. Now that you've learned about the 7 assets, let's present the key benefits of compound interest. Compound interest offers several important benefits. The earlier you start investing, the more time your investments have to grow and compound. Compound interest also allows for the generation of passive income, as gains are reinvested to create a cycle of additional returns without the need for active work. Furthermore, compound interest helps mitigate the effects of inflation. As inflation erodes the purchasing power of money over time, investments that generate returns above the inflation rate help preserve your purchasing power. Psychologically, observing the growth of your investments over time can foster patience, reinforcing the importance of staying invested and avoiding impulsive decisions based on short-term market fluctuations. Remember that compound interest requires time, discipline, and a long-term perspective, but it has the potential to secure your financial well-being and even enrich you over time. Take control of your financial destiny and watch your wealth grow. Today, we've seen that compound interest is a powerful tool for wealth building. By understanding the principles of compound interest and strategically investing in assets, it's possible to unlock the potential for long-term wealth accumulation. Whether investing in stocks, real estate, bonds, precious metals, or other assets, the key is to start early, diversify investments, and reinvest gains to harness the power of compound interest. Leave a comment about your thoughts